up comes a very hot topic. You know, when we take a look at how the journey of startups is, from the fact that it starts with an ideation and then, of course, reaching a unicorn status. The other day, I was reading a report which said that as of 9th February, at least that's my latest understanding, there are close to 88 unicorns in India. And I do remember the time when unicorn was, the word itself was as rare as the unicorn. But here we are with close to 88 unicorns already. And I think that's a humongous number, which also shows the growth, the transformation, and the capability, the revenue generation as well. So looks like it's poised for a greater future indeed. I mean, that's a beautiful thing. But while we do so, here comes the big question that's on everybody's mind. When we talk about the Indian unicorns, is it really the next big thing? Or is it the next big bubble? And I'm telling you what, that I'm really, really keen on this conversation as well, because that's a question on everybody's minds right now. So let's find that out with none other than Rajeev Misra, CEO, SoftBank Vision Fund. And extracting his insights would be Samidha Sharma, editor, Startups, an emerging business at the Economic Times. Well, Rajeev, in fact, serves as a CEO of SoftBank Investment Advisors, the investment manager to the SoftBank Vision Fund. And previously, he was also the senior managing director and partner at Fortress Investment Group. And prior to this, he served as a global head of fixed income, currencies, and commodities at UBS between 2009 and 2013. So, ladies and gentlemen, time to find out, when we're talking about Indian unicorns, is it really, really the next big thing or the next big bubble? If that's a question on your mind, time for the next conversation.
Hi, Rajeev. Thanks for joining us here today at the Global Business Summit. Really appreciate you taking out time. It's been quite a, for the past 6 months since we last spoke in June. Things have evolved quite quickly, especially in the past month or so. I want to begin by asking you a little about whatever is happening on the geopolitical front with Russia's attack on Ukraine. Also, if you look at the macro situation with the crude reaching some 118 per barrel, $118 per barrel. What are you making? I mean, people are talking about a liquidity crunch like 2008. Is some sort of a global downturn or a recession around the corner, Rajeev? What are you making?
Yeah, there are a lot of factors. Look, October was the peak in the tech stocks, and then after October last year, investors started worrying about inflation, right. And the Fed came out and said that they will taper the bond buybacks faster. So we had a 1.5 year kind of liquidity boom from May 2020 to October 21, with zero rates, with a lot of subsidy checks going out to investors and a lot of retail participation in the stock markets, leverage building up. But let me just say, before I go into the concerns, let me say the positive things you asked. It's nothing to do with October, with 08. Because the banks are in great shape. The financial system is in good shape. There's enough savings and current account deposits in the US are at record highs. Individuals have enough savings. Unemployment is at record low. House prices are high, which is the biggest asset in Europe and US that individuals have. So the financial system is fine. It's not an 08 situation, which was a financial crisis. If you look at the stock market in general, the NASDAQ and the S&P is not down that much from its peaks. And the NASDAQ is down 18%, the S&P is down 10%. While the high growth tech stocks are down 30%. So yeah, the cash flowing companies and the and so on are actually not down. Some of them are up because the index is, if you look at India versus the US index has 40% tech in it. Well, India is small, 14% or 12, 13% tech. Tech is a very small component of the Indian index.
Right.
Despite that, the indices are not down that much, despite the fact that a lot of the growth stocks are down 40–45%. I'll give you some statistics. 75% of tech IPOs in 21 are below IPO price.
Yeah.
So coming back to your question, let's talk about the Russian crisis. I think this will be a prolonged affair. I think this will have its costs. The West will pay for higher inflation. It's not just oil, it's wheat, it's soybean. 25% of the wheat production in the world is from Ukraine and Russia. And there is a drought in Latin America. So soybean and wheat production is down. So you'll have ramifications on hydrocarbon inflation, food inflation, European exports to Russia, etc., etc. And this will be a prolonged affair because the West is agitated and united that they're not going to step back. The sanctions will last for a long time. This is not going to go away, which is an issue because it will lead to inflation. But the West has, in my view, I'm speculating, decided that they will take the cost of inflation versus the aggression and seclude Russia from the Western economies. Okay, which is bad news. The Fed might go a bit easier on rate hikes because of that. So that's a positive. But the rate hikes will have to happen because inflation is going to be rampant. But there's enough liquidity in the system. So
you're not concerned about any liquidity issues going forward, Rajeev, and I want to tie that up with my question on, while you touched upon, the overall public markets, that liquidity concern had really spooked the tech pack, in December itself. The repercussions of it we saw in India a little later. But talk a little about, your portfolio, the fact that there are so many IPOs which happened from the SoftBank portfolio in India and obviously in the global markets as well. What are you telling your portfolio companies? How are they kind of looking at the situation over the next 6 months? You've already mentioned previously that the private market valuations will have to reorder and rebalance, keeping in mind whatever's happened in the public market. How are you preparing your portfolio companies? What are you telling founders as they go in fundraising?
So let me explain the landscape and then I'll tell you what we're advising the portfolio companies. Because the landscape is this for the next 6–9 months, year, whatever it is. I think number one, private financing, which was available in plenty in 2020 and 2021, will be limited. I can see the change already today versus December and January, where it's bifurcated. So if a company is raising very early stage, 50, 100 million, 150 million, you have to write 20 million checks. There is a lot of crowd who are willing to do that. But if the company is trying to raise 250 to 300 million and 500 million, they're struggling. They're struggling to find a lead investor who will come in with 100, 150 million.
Already happening, Rajeev? Are you seeing that?
Already. Okay. Last few weeks. So the private markets, we have seen certain investors back out after verbal commitments. So that's number one. So private markets, which was the easiest, if you're raising a lot of money, trying to raise a lot of money, there is reluctance unless the valuation and number two, the power of capital has shifted back to the capital provider.
Right.
Where last year and year before, we had to convince the founder why they should take our investment, right? Where I had to go and beg why we as SoftBank are a decent brand and how we can help, and which is all true.
Yeah.
And they had multiple choices of investors sending them term sheets in 1 week and without detailed due diligence and so on and so forth, where they decided the price and the valuation. That has changed. The power has come back to the capital provider, which is healthy, because you don't want to misvalue companies and so on and so forth. Number three, we have done an analysis of our 300 plus companies and put them in 3 buckets. Number one bucket, the companies that have runway and capital on the balance sheet for more than 2 years. They're fine. Number two, which have runway for more than a year. And number three, which is the worrisome ones, which have a runway of less than a year, which means they need to raise capital in the next 12 months, in the next 6 months. And in that bucket, we are working with them, to rationalize the costs, B, to get out there and raise money at whatever valuation. So we are having those discussions with our portfolio companies saying, look, don't get greedy. Whatever the valuation, whatever the market can bear,
take it
in the third category, so that you have enough capital. Because what happened last year was a lot of companies didn't raise a lot of money thinking that their valuation will go up, and why dilute now too much. If you look at Fund 1, when we invested in 17, 18, 19, we invested in 83 companies, $83 billion. Average ticket size was $1 billion. Some 5, 6, some. Fund 2, we invested $51 billion across 220 companies, 150 million each. Why? Not because we pulled back, because nobody was raising that much. Because they felt, hey, why dilute? Because you can raise a year later at a higher valuation. Yeah. And so not a lot of capital was raised for a longer term. And the next point is that the IPO markets, which is the final frontier for raising capital, is also getting very selective.
Yeah.
Across the world. I mean, there's only one major marketplace to raise capital, which is the US. It's not the UK, Frankfurt, whatever. It's the US. And when you, as I said, 75% of tech IPOs are below IPO price from last year. Doesn't mean IPOs are closed, but it is definitely becoming a lot more stringent. So that source of capital also is an issue. So companies should factor in that IPOs will be delayed, which has other ramifications, like ESOPs for the employees, employee morale, etc., right? Because the employees want to see liquidity, and they've been promised that the company will go public at some point and they can cash out. Sorry, Samidha, your question.
Yeah, no, I want to get you on a, on your deployment. Like you have mentioned, in our previous chat that you deployed about 2 billion in India. You've later on said that you can commit almost 5 to 10 billion in 2022, but obviously this was prior to whatever has happened in the past few weeks. Have your plans changed?
Oh, no. The good news is we have capital. We have enough liquidity. our team is working hard in India. But if you were in my shoes, you would do the same, Samidha. You would sit back and wait for the market to rationalize in valuations and find interesting opportunities. I mean, if you read Warren Buffett's newsletter, he's at 92. He's not in a rush to deploy capital. He's sitting on 110 billion of cash. We're sitting on a lot.
Right? You have slowed down.
We have slowed down. We have slowed down not because we have said no to investments, because we're not finding enough investments around the globe at the right valuation.
Okay.
Not slowed down because we are worried about investing, but it is not yet. The market has not reached a state of equilibrium where the private markets are still kind of valuing themselves at where the public market multiples are.
Okay. You're saying there's more correction still to happen in the private market, and therefore you're going to wait.
By definition, it takes time because it's sticky.
So, you spoke about, IPOs, and in India, for the first time, there were companies sort of lining up in the past 6 to 8 months to go public. Great opportunity for investors to get an exit through an IPO. Now, 2 of your companies also went public, while Nykaa, Zomato have also fallen quite a bit from their listing price. Paytm was your portfolio company, which had a debacle in its public market debut. What do you make of Paytm and some of the other companies, in terms of valuation, in terms of the fundamentals, and has the Indian public market, will it be receptive to more such IPOs going forward?
So there will be issues with 1 or 2 IPOs getting mispriced.
So you think
that doesn't mean that the tech IPOs, which will be a big part of the Indian stock market going forward, like it is in the West, because that is the new economy. And there's some great companies which will come through, and who are profitable, who are market leaders, like delivery, like First Cry, and others in India. So that will happen this year. The Paytm IPO, we were a large shareholder, 20-odd%. We didn't decide the valuation price. It was decided by the bankers and the company and the board. And we are the second largest shareholder after Alibaba and Alipay. So 20 billion where it IPO'd versus where it is today at 8 or 9 billion. Was obviously perhaps not the right price. It has to grow into that price. While Policy Bazaar is doing well, which is a profitable company, which is step by step growing, etc., and is a market leader in online insurance. Market leader by far. There's no other competitor. So it depends on the company. The delivery, same, market leader in logistics, which is a key sector. First Cry for e-commerce, offline and online, for children and mothers. Lenskart will come at some point, which is similar. So, out of 10 IPOs, if one of them is mispriced, doesn't mean that the IPO market.
But you're saying investors have taken to this new age tech pack, and public market investors in India will have the patience to kind of let them maybe lose money, burn money, and price, growth over all of this?
No, no, no. There are two things. Okay. Let's take Laika, let's take Zomato, which we are not invested in. I mean, the IPO was fine. It's just doubled after the IPO. The books were so big. The demand was, there was a scarcity value of growth tech companies in India last year. So you're seeing some of the early effects of the first. India never had a tech IPO for 10 years. Okay. There was no exit. And suddenly you have 4 or 5 companies go out. Books are 40 times oversubscribed, etc., etc. Never seen in 2 weeks post IPO the stock doubles. Something went wrong. Either we undervalued the company or the demand was so much. So that exuberance is coming to an equilibrium, and investors have learned that it takes time to make money. It's not going to, it's not something that's going to double in 6 months. It'll take 4 years to double, which is still okay. Make 15% return.
Just want to wrap up, Rajiv. We don't have too much time. I want to ask you, while you said that your deployment will not change because capital is not a problem for SoftBank. I want to also understand: are you going to look at other kind of assets? I know we keep asking you this, and there's nothing very concrete that you've ever spoken about. But I want to ask you again: are you looking at assets which are more from conglomerates, something like a Tata Digital, because obviously there is a lot of push from Reliance, which is this other big, group which is taking digital very seriously. Is there any intent to invest in any of these assets, specifically something like Tata Digital?
So we are speaking to a couple of conglomerates. Tata, Mahindra, who have amazing offline reach, amazing brands. They don't have to spend on customer acquisition because they have consumers across all their platforms. It'll come down to 2 things: the valuation,
okay,
and B, how independent and aligned is the management. If the management doesn't have ESOPs, doesn't have independence, will get stuck in the bureaucracy of the organization and won't be able to take decisions fast enough, then it doesn't work. It doesn't work for any of us. Even SoftBank trying to do it, or IBM trying to do it, or Microsoft or Google. Why haven't Microsoft and Google had great startups inside them, which they've spun off or whatever? Because large organizations are not as nimble as founder-led organizations.
okay.
A founder-led organization is very different than a committee-based or employee-run organization. Okay, very different than an employee-run organization.
Is this sort of imminent right now, Rajiv? And I mean, we'll sort of wrap up on that note.
Yeah, we've been working for 6 months. We've been
Okay.
working for 6 months.
Okay. All right. We'll get back to you on that and get more details. Thanks a lot, Rajiv, for doing this.
Thank you, Samidha. Anytime. Thank you.